Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. Joining you all from sunny Panama City today, Panama. Disclaimer, guys, nothing that you see on the channel is financial advice. It's just my opinions, what I'm doing with my funds and the funds that I'm in charge of. Nothing is to be considered advice. It's just what I think and what I'm doing. It may be right, it may be wrong, and it may not necessarily be right for you. So make sure you seek the appropriate professional advice. So there's a disclaimer, housekeeping out of the way. Update today is about Crassus Investments and eToro's portfolio. And so I've just like to point out January for the month, excluding dividends, we had a return of over 9.5%, which obviously very, very happy with. Some of the theses that I've been mentioning and been a little bit frustrated that they haven't been playing out in terms of their nominal pricing the way that they perhaps should have been. They're starting to, but I think we've got a lot of volatility ahead. I've given more credit to the S&P than is due because I actually put in today's date and it's been on a tear since the Fed meeting. So we actually had a better alpha than 2%. This is the 1st of February as opposed to the 31st of January. But anyway, it doesn't really matter. We outperformed the S&P. And so that's that. Looking forward. Don't know what's going to happen in the short term, but I've been very surprised at the strength of the US market or global markets in generally, but particularly the S&P 500. I thought that we would be looking at a weaker start to the quarter. And I think that the pain might still be ahead. So still cautiously treading forwards. Today, we're going to talk about macro view. 3 points I want to talk about that I'm interested in. I'm looking at inflation. I think it's going to really surprise people on the upside. I think commodities are going to revisit where I'm looking and do some valuations, some relative valuations around that. Okay, so any guesses on this particular chart? So it's very, very strange that the S&P is performing so well relatively recently when this is actually the PMI for US manufacturing indices. So when it goes below 50, it is suggested that the economy is starting to go into contraction. So manufacturers are getting less orders, which suggests less demand. And so sometimes that can take some time to float through the system. And at least the way that I see things, could be wrong, I don't know. You've got these types of indicators compared with the financial indicators of the market. The financial indicators of the market are happy that the rate at which we were expecting interest rates to rise is reducing. And so people are all happy about that and they're bidding up the prices of assets. And yet when we look at the real economy, where the manufacturers are saying that they're experiencing weakening conditions already. So I expect this to start to be reflected into some of the numbers coming into the end of this quarter, but we will see. So I want to have a little look at a few things around the PMI. So PMI for the US fell in December, and Americans seem to be shifting some of their spending away from goods to consumer goods to services. April 2022 aside, which is obviously COVID, this is the lowest reading we've had in nearly 7 years. Okay, so that's it's quite significant, on the back of a tightening monetary and some fiscal policies around the world. New orders and export orders have declined into negative territory. Employment still seems to be relatively strong. What seems to be accounting for this or explains this is that instead of firing employees, companies seem to be pausing, and they're finding other ways around that without having to necessarily put it in the books as a redundancy package paid out, let's say. Inventories are growing faster, and that is indicative that manufacturers or wholesalers, retailers even, are finding it difficult to move their inventory. They've got less demand for what they sell, and so those inventories start to pile up. So that's an important indicator. Only 2 of those primary manufacturing industries were in growth, which was metals and petroleum/coal products, energy products that we've been harping on about on this channel for quite some time. So I'm not going to go into that, but it's indicative that those areas are very inelastic demand sectors and that have a shortening or a dearth in supply, which has been the thesis basically since I started this channel. Consumer optimism, so it shows you how consumers are feeling about their spending power. And this is obviously at odds with what we've seen recently today as of the markets close, but 1st of February here on Eastern Standard Time. we saw not a blow off top, but we saw strength in the markets, and yet the consumer optimism is certainly indicating anything but that. Central bank balance sheets, and obviously this is the interesting factor. So here we go to 2008, we had the GFC, there's a huge increase in the balance sheet. Then they tried to correct that because the powers that would be, as you can see, there's a little dip down here, if you follow my cursor. They tried to tighten the balance sheet. They realized that it wasn't really going to work with all the debt. Now, if it wasn't going to work with that amount of debt, what's going to happen here? How is that going to work? If we go to 2020, you've just seen this, it's just gone vertical. And now they're trying to slow this pattern. My question mark there that I've indicated is, well, what happens if this in a few years' time, we look back in hindsight and it looks like this little red circle over here, where they tried to tighten conditions, they realized they couldn't, and then we went vertical again with loosening monetary and fiscal policy. We'll see. Fed funds rate versus M2. Okay, so the peak here is obviously in a downward trend. The Fed getting the cost of money, at least in a risk-free rate, or the Fed's funds rate, it continues to hit its head on this resistance line, and that resistance line is dramatically decreasing as we increase the monetary supply. And it's pretty basic. As you burden yourself with more and more debt, you lower how far you lower the tolerable rate at which you can borrow or service said debt. So it's going to be an interesting ride. I don't know where we're going to end up in terms of the Fed funds rate, but we've seen already today, Jerome Powell said that the Fed will be raising rates only at 25 basis points as opposed to 50, which was probably in the initial plans, because they realize that things are probably going to break should they continue full steam ahead. Core inflation takes out things like energy and food, kind of important if you ask me. But anyway, this is what I would want to talk about. These are the expectations of the forecast currently. And I don't know. I think on a relative basis, month on month, sure, things will start to peter off a little bit, only because we've had such strong inflation metrics month on month recently. And so on a relative basis, these high base effects will mean they may come in a little softer, but secularly over the course of 1 year, 2 years, 5 years, 10 years, prices aren't coming back. I don't think we're going to see a car next year cost less than what it did 10 years ago, all things being equal. So I think that this is going to surprise on the upside. I think another reason why that may occur is decoupling of geopolitical relations. All of a sudden, you can't outsource cheap labor to China like you used to, because we have energy security and manufacturing security. So countries around the world like the US have realized the importance of being able to produce strategic goods and services such as semiconductors. They're moving away from China. And so if it's not the Chinese that are building these semiconductors, or at least assembling them, then that means it's Americans, and you're going to have to pay them a lot more than what you did the Chinese, all things being equal. So that would be one force: the cost of energy, the cost of neon gas going into making semiconductors, just as that example. I know natural gas has recently sold off a cliff dive based on European inventories being high because they used less this year due to warmer weather. But over the next decade, given the fact that we need to be spending over $1 billion in capex to maintain stay flat oil or petroleum inventories, let's say, I don't see how we're going to offset the cost of that energy input. So if you've got higher wages, higher energy inputs, it's inevitable that that's going to start to come through into inflation. I think that people are probably asleep at the wheel with regards to those expectations. Again, if you look at the CPI, what people are expecting by the end of 23 or 24 to have a 2 handle on it, due to the base effects, maybe, but I don't know. I really don't know. It's going to be an interesting one. So I thought I would point that out. I think that might be one contrarian trend that's worth looking into. Commodities, so oil. Here's oil as of 2008, before it fell off a cliff. Okay, and what you've What I'm interested there is oil peaked at around $140 a WTI. This dotted line here with a number of rigs, the number of production rigs is the next slide, from the Saudis and the US. Okay, so as you can see, the Saudis ramped up production, and then we had that possible oversupply, increasing inventories coinciding with the GFC. And so we just saw that production start to tank on the back of a tanking oil price. And then we come through to here. Okay, so pre-COVID, oil was around 76 WTI. It's around 79 at the moment, in that range. And yet here's what's interesting. So if you look at where we are today in terms of the US production and Saudi's production, Saudi, you can see there's a big difference if you follow the cursor between where production is today versus where it was. And yes, US production is a lot higher than where it was in 08, but that's due to shale mainly. And we've seen these shale rigs starting to become more and more gassy as opposed to producing liquid oils. So it's going to be interesting to see if people expect the shale region to be able to pump out the amount of oil that it has in the past. There are a lot of smart people that have shown that that's very highly unlikely to be the case. So another potential wild card into the mix. And if we look at US production versus where we were pre-COVID, obviously we're still yet to get to that level. And the Saudi production is a long way from where they were producing. And they've said that they cannot hit this sort of 14 to 15 million barrel a day production until at least 2026, I believe is what they said. Rig count, here's what I'm looking at. So again, there's roughly that 2008 period. Obviously then with oil price dropping on the back of the GFC, there was no need to put that many rigs into production because you weren't going to get the oil price that you wanted. And so then we saw rigs starting to come up, and then we saw the rigs starting to come down. In terms of Saudi production, we saw US start to increase their production, mainly due to shale, as I mentioned. So here we are today. If we look back to pre-COVID, when we were around that $76 WTI, you remember from the previous slide, the rig count is way down from the Saudis, okay, like way, way, way down. And if we look at where the US are, their rig count is up, but it'll be interesting to see for how long that can continue. So they're getting back just about to where they were pre-COVID in terms of the number of rigs online, at least according to this chart. Okay, now I've used quite a bit of Crescent Capital's charts, so credit to them, and link will be in the description. Make sure you go and subscribe to their YouTube channel. They've got a couple of things that I think are very interesting. So quarterly candles, oil has broken out and now it's touching down around that resistance. We'll see does it break that down below, in which case we're going to have lower oil prices. I tend to think not. I tend to think this might act as a technical resistance point. And again, a lot of the investments that we've made earlier over last year and the year before are profitable with oil in the sort of mid 60s to 70s. I think once you get over that 85, call it 80, 85 dollars WTI, it's where the offshore guys really start to mint the cash. Okay, uranium. I want to talk about uranium. Been a uranium bull for nearly 3 years. Had a very interesting conversation with a very important fund manager and research leader here in Panama. And so catching up with him hopefully next week. Uranium, this is what we're looking at. And we've started to see things tick above $50 in the spot market. Sprott are raising money for their Sprott Physical Uranium Trust. And they're trading at premium to NAV. So they issue more units, and that means that they can take on more money purely for the purposes of buying more uranium. Takes uranium off the market, they hold it, it raises the price. Once that trades at a premium to NAV, you see where I'm going. You get that reflexivity in terms of uranium. I don't know where we're going to finish up spot price wise, but everyone that I've talked to in this industry says that as it stands right now, to get these projects into production, these newer developers are going to need, more like an $80 spot price in order to feasibly get these things up and running, take into account the inflation over the last 24 months. So given the supply tightness in the market, and given geopolitical tensions with Russia accounting for most of the enriched uranium, it just seems all to be pointing in a very bullish direction, barring the odd left tail risk. So how am I playing it? Well, in eToro, there's really only one way you can play it. You can buy Cameco stock. I've chosen to go with just the beta of the ETF. I don't normally do that, but I think it's just such, I think it's the percentage play to make. And I think that it's the easiest lower hanging fruit to play. So if you look at the futures price of the physical uranium versus buying the ETF of the miners, explorers, developers, producers that are all in the represented in the URA ETF, as you can see, it's trading in this ratio in one of the lowest levels it ever has. So what this means is the producers relatively valued to the actual physical uranium are extremely cheap according to this historic ratio. Okay, so Kazatomprom, the most important producer in the world, have said that they are reducing their guidance by, I believe it was 3 to 5 million pounds this year. That's unless I'm having a brain fade, that's what I read recently. It accounts again for around about 3 to 5% of global production. Okay, so it's a lot. I remember reading that. So again, we've got increasing demand, we've got an already tight and depleted supply, and that was just more bad news on the supply side. So I would expect that to continue to push up physical prices. The reason I've shown this 200-day moving average here, this red line, is that it looks like it's dipping to just sort of touching off that 200-day moving average, which technically and traditionally is a good entry point. So I thought that was interesting. Thought I'd share that for uranium. Gold has been interesting this year. It's been boring the last 2 years, kind of talking about gold, and people just don't want to hear it. But it's done well for me. What can I say? It's a savings mechanism to hedge against my old local currency in Aussie dollars. It did very, very well. Continues to do well. It's not fancy, but here we are looking at a breakout. So you can see these futures here, 2023. All these technicals look super bullish. There's a lot of momentum recently coming into gold, as you can see with the RSI here. The MACD's got a huge divergence, number one, and it's starting to see a bit of a crossover, but it's still a huge way above that baseline. So I would not be surprised if we hit over $2,000 an ounce US for gold this year. I'm holding the bullion in eToro via the Sprott Physical Gold Trust. I know it's 1-for-1 backed, and so I have great confidence in that particular product. We own Wheaton Precious Metals, which is a royalty play on precious metals, and also Barrick Gold. Very small positions, because I'm not a position for Barrick, that is because I'm not 100% convinced on how their margins are going to play out. Yes, gold price will probably increase, but what's going to happen to the price of their inputs, one of which is diesel, which I would be worried about if I were, say, Mark Bristow, the CEO, and having to manage those margins. So just because their revenues may increase doesn't mean their margins will, whereas Wheaton, being a royalty player, will. And I'm looking at building out a position in B2 Gold. I think they're interesting and potentially undervalued from a producer standpoint. In any case, let's take a look. So the miners, having said that, the miners do look undervalued relative to the physical. So doing the same thing I did with uranium, comparing the producers versus just buying the physical, same thing, but we're talking gold here. Okay, so according to this is a historically very undervalued time to buy gold producers versus just the physical gold, all meaning that, you know, it takes very few units of physical gold to buy that 1 unit of the miners index. So potentially based on that would be the counter argument to say that the miners are actually quite cheap. Copper, just interesting. Like I've really wanted to establish a position in copper, and I haven't been able to do it. Every time it drops down, I think, yes, this is going to be my time. It dropped below $4 and I was getting ready, and it then took off again. And so at the moment I'm still watching copper, wanting to get into it, but I just haven't really had much of a chance to do so to which I could justify it. So anyway, copper versus copper producers as the sort of the global ETF. Not much to say here. It's kind of in a high to mid range, but I'll be keeping an eye on copper. I think it's a very, very important commodity. Just not cheap enough for me to buy it yet. Silver futures looking very interesting, super volatile actually. starting to come back down below 200-day moving average, and then it's shot up recently. Whether this is a real breakout or whether it's going to come back to test that 200-day moving average, I have no idea, but we do hold physical silver in the Sprott Physical Silver Trust. So same thing as the gold one, but a unit designed by Sprott. The silver, we did hold Fortuna 2 years ago. It just had problems with the government and all that sort of thing. So it's just really volatile. We should have, in the end, would have done very well out of it, but I decided to take that out and to put into more cash flowing opportunities and just holding the silver, because I think if we do see a true silver bull market like you've seen here a couple of times in the past, just holding the silver will give you very good return. So it's a good hedge against a weakening fiat currency. It's kind of an industrial metal as well as a precious metal. And so, yeah, we want to have some exposure to it. And I just think that, again, the silver miners look cheap according to this chart, but I find it just difficult to pick the right one that will keep their margins, or keep their mining license, as in the case of Fortuna. Another interesting point that the guys at Crescott made in their latest video was the amount of volume going into the TSX. The Toronto Stock Exchange is really where most of the roughies are, the explorers, the dicey but potential moonshot developers are listed on the TSX. And so if you look at where capital's been flowing, if you were to track that, you can kind of get a sense as to where the market's moving. Our capital flow is moving towards precious metals explorers and developers. And in this case, we haven't had much. We've had a big drop off and we haven't had much to celebrate in terms of capital moving into that sector, but it's just starting to tick up. And if that is a sign that capital flows are moving out of other sectors of the market and into this smaller cap or venture exchange, these things have tiny market caps, so it doesn't take much capital for them to really start to take off. So I thought that was very interesting. And if you look at some of the historical returns and the verticality of those returns based on history, it's certainly got my attention. Okay, I've spoken a bit about Brazil recently in the past. I'll briefly mention some of the key topics, and then I'll make potentially a video completely dedicated to Brazil. Here we're looking at Brazilian interest rates. Okay, interesting. And I think that now with the US slowing some of their rate hikes, some emerging markets will feel a reprieve or relief from two fronts. One, their cost of foreign debt obviously drops, and so that gives them a bit of relief. They don't have to come up with as many US dollars to service those external debts. I'm thinking of sort of Argentina, for instance. Brazil, another opportunity for emerging markets would be if they can maintain decent interest rates. Foreign capital is more likely to move into their markets because you're getting paid a high interest rate, and you might be getting a real return, depending on the country, when compared to the US, where you're getting a negative real return once you take into account for inflation. Okay, Brazilian real futures looking low historically. That's all I wanted to point out there. Could we see a return to mean potentially? Once that US dollar starts to move below its 200-day moving average, I think it could be a sign that trading algorithms will get the signal to flow capital into foreign markets. Okay, relatively valuing the Brazilian Bolsa and the S&P 500. As you can see here, historically at least, all else being equal, the S&P is extremely expensive compared to the EWZ ETF that tracks the main Brazilian stocks. And so Brazilian stocks on a relative basis compared to US stocks look extremely cheap, according to this historic ratio. Brazilian ETF using the MSCI just has different weightings that track Brazil. So here, below that 200-day moving average, a long way below previous all-time highs. And so it's going to be interesting. To see if we can break through that. It could be off to the races. Who knows? Okay, so that was over a longer time frame. Here we're looking at the yearly time frame for the same ETF, and we're just starting to test that 200-day moving average, which is a very bullish technical indicator. So go and check out Crescent Capital. If you guys don't follow Tavi and the boys over there, they do a great job. So make sure you subscribe to them. And I used, I think, 2 or 3 of their charts. So I wanted to give them credit for that today. And if you're interested in a longer term value fund that invests based on value and cash flow, that's what we do. You can add some funds, or you can add us to a watch list using the link in the description. You can hit me up on Twitter. And as always, please do like and subscribe to the channel. It makes a big difference to the algorithm. Thanks for watching, guys. Take care and be careful out there. I think more pain to come. Otherwise, I look forward to catching up with you in another video shortly.